The stock market is 100% about to go through a correction. I'm talking 20 to 40%, and this is a guarantee. So if you're invested in the stock market, this is definitely a video you will want to watch, as well as this has some implications for crypto, because I do think we are hitting our bottom on crypto right now. Not saying we couldn't fall somewhat further, but I do think most of the blow is done to crypto. Now, for stocks in particular, some of these facts and charts might blow your socks off, so you're definitely going to want to stay through and watch this whole video. But do me a favor and hit that like button for me. I would greatly appreciate it, as well as subscribe to the channel to stay up to date with all of this great information, crypto videos, and everything else in between that we like to cover on this channel. Welcome to the family. As well as there is a Patreon link down below. I got my buy and sell alerts, as well as one-on-one Q&A for any investment questions you guys ever have, as well as get $5 free in whatever stock you want. Link down below in the description. 2-minute sign up, no deposit necessary. I got Tesla. Let me know what you guys get down below. With that, let's get into it. There is two things that the stock market absolutely hates to hear right now. One of those is the I word, and we are talking about inflation, which is here and is being measured on a monthly basis. So it is in fact here. But the second worst thing the stock market hates right now, that is all juiced up on low interest rates, is the fact that COVID just hit a June 2020 low. Now you mix the two together, and that is a recipe for a correction, 100%. Let me explain this for you guys if you are confused as to why lower COVID cases is negative for the stock market, because really throughout this whole year, bad news is good news is bad news. So here is the scoop. As of March 19th and March 23rd, the Fed before that had cut interest rates on a Sunday in an emergency fashion, which did help accelerate the stock market crash that ultimately would have happened either way due to the pandemic. Now, the fact that they have kept rates so low is because COVID cases have been so high, giving, people a choice not to work or not. That is partly why we still have a high unemployment rate, because there's clearly jobs out there. So once the COVID cases start to go down like they are right now, and we have proven inflation numbers coming in very, very high in the 4% range, that does mean the Fed will have no choice but to raise interest rates. And the market is going to get spooked probably tomorrow and throughout next week, just because COVID cases are hitting a low. And every single time we started to hit lower COVID cases, the stock market started to get real scary. Now, a lot of people do think still the Fed isn't going to raise interest rates till 2022 or 2023 is really when they have indicated they will consider raising interest rates. Now, this is not going to be the case if inflation data continues to come in very high, which it obviously will. We see it all around us. The biggest problem with the Fed raising interest rates is about 20% of all companies listed on public exchanges are considered zombie companies. A zombie company is simply a company that is neither dead or alive. In other words, it is in so much debt that any cash generated is being used to pay off the interest on the debt or not actually reduce it. Now, this is obviously very bad for the almost 20% of public companies that are listed on our stock exchanges. Now, in a normal interest rate environment, these companies, or at least a good portion of these companies, wouldn't have been able to survive and repay their debt. Now, the fact COVID cases have been pretty much elevated since summer of 2020, now we are breaking under those lows, is not a good sign for a lot of these companies. Now, this is the number one metric that is signaling a 100% crash or correction in the stock market, and this is Bitcoin overlaid with the Nasdaq. Bitcoin is in blue, Nasdaq is in orange. That is just representing the whole stock market. Every single time there is a move down or a move up, they both move the same. Now, one or the other might move more, like we've seen throughout, the summer, that the Nasdaq really rallied more than Bitcoin, but we could see in March they both fell about 50%, and that's exactly what happened here. The only time they did not run together was in 2017 in December, when we really had a crypto bubble. As the stock market was going down, crypto was hitting all-time highs, and you can see that right there. That is quite obvious. But every single other time, this has been running together. So we have this major sell-off in crypto, which the rubber band effect just says that the more something goes down, the less chance it has to keep going down. And that's pretty much what we have seen already in the crypto markets. So I do think the crypto markets are leading the way for the stock market to come down. Now, I don't think it's going to come down as far as a percentage wise as much as crypto has, because crypto has fallen about 50% still right now as I'm recording this, about 50% down. I don't think the Nasdaq or the overall stock market is going to fall about 50%, but I could definitely see a 25 to 40% correction, probably putting us somewhere around 44,000 on the Nasdaq, which would still be a great gain from the bottom in March or even the high of 2020. But these always run together, literally every single time. So you're a fool not to look at this or to discredit this, but sometimes there is a discrepancy, like right here. When crypto is hitting its all-time high in January 4th, 2021, and started to come down right after that, the stock market was still rallying up until January 18th, when it then started to come down a little bit, and that is when crypto started to go higher. So I do think they are going to, reflect each other. Like I said, I don't think the stock market is going to come down quite as much as Bitcoin on a percentage basis, but I do think at least a 20 to 40% correction is going to happen in the stock market, and that is a 100% guarantee. Now we're going to look at some more factors. It's not just this, but this is the biggest telltale metric that I'm using right now to gauge when the stock market is going to crash. Another metric that I've been looking at is the S&P price to earnings ratio versus historical averages. And just to give you guys the overview, it says the P/E ratio is a classic measure of any security's value, indicating how many years of profits at the current rate it takes to recoup an investment in the stock. The current S&P 500 10-year P/E ratio is 36.7. This is 86% above the modern era market average of 19.6, putting the current PE 2.2 standard deviations above the modern era average. This suggests that the market is strongly overvalued. Chart below shows the historical trend of this ratio. For more information, okay. But basically, we are at our, pretty much all-time highs besides the dot-com bubble, where all the internet stocks at the time were super overvalued, weren't turning any profits, but it was pricing out it'd be like 20 years to make a profit on these. I'm just throwing a number out there. I'm not sure the exact amount of years that it would take, but it was insanely high, hitting 132. And we're 86% above the historical average, and this was May 21st, 2021. So we are way up there, guys. So on a price to earnings ratio, we are definitely due for some kind of pullback, but given all the metrics that we are talking about in this video, I do think it is going to come sooner rather than later. Now, the other lowest points were about 1980, but a lot has changed since then, and it doesn't necessarily signal a crash is coming, but it's definitely a good indicator. Those are the biggest metrics that I'm looking at right now to indicate that we are most certainly going to see a crash or correction in the next couple of weeks, or most certainly the next couple of months. But there are some ways to hedge your position and potentially make a ton of money in the process. Now, the first way is just by hedging your largest positions, and that would be like NEO is one of my largest positions. So you really got to be good on the timing here. And I don't really ever try to, pinpoint when something's going to happen in the markets, because quite frankly, you never know. We could go up another 100% and then come down 50% in a year. It's just widely unknown when it comes to markets. But if you do think there will be, some kind of crash or correction in June, July, you could come to like August, September, October, and I'll just do September, because I do think if we are going to go through a market crash, it would probably be before this. So, and I wouldn't necessarily do this trade. I'm not going to do this trade, but if I were going to, I would do something like a NEO $25 put. And since I have 100 shares in NEO, it would fully protect me anything under $25. So if you want to be fully protected, you could go to the $35 strike, buy one of these puts, and essentially for every 100 shares that you do own, it is one put. So a put represents 100 shares, and you agree to sell your shares at $35, which is actually $1.04 over its current price. So this actually is worth right now $104, given NEO is $33.96. You have the right to sell the shares at $35, but you're paying a premium, and that $4 premium is pretty important here. So basically, if you were to buy this, anything under this $35, if we fell to, $20 on NEO, this contract, this $35 put, would be worth $1,500. Now, you can obviously make a lot of money doing this and protect yourself at the same time, but if there was never a crash before September, or at least in the stock that you have to put on, or whatever the case is, we're going to go into a couple more examples of how to hedge your position, then you would lose this whole premium that you are paying, this $513. You would lose that. And the same thing does apply for further down the chain. At $30, you're paying $269 bucks to agree to sell 100 shares at $30. So if NEO were to go to $20 by September 17th, this would be worth $1,000. But you're only protected under $30. So this contract would be valueless if NEO closed over $30 by September. Now, you can always sell out of these. Maybe you guys do know this, maybe you don't. Let me know if you want a in-depth options video. But another good way, a couple other good ways to hedge your position are with SPY puts, and this is the S&P 500, and basically you see this huge rally, right, pretty much consistently just going up after our March crash. So even on a chart, it looks like we are overdue for some kind of correction, like we've seen over here in 2018 with the trade war we had going on with China. We were pretty much at that tipping point yet again, and then boom, we did end up going through a correction, and then in 2020 we were due for a correction. I'm not quite sure if it would have happened if COVID never hit, but we did hit a low on the S&P of $228.80, and it is currently $415. So we are much overdue for a correction or a mini crash. So I would probably go out to probably September, just to be on the safer side, and you could do a put. And remember what the SPY fell to last time, because the odds of it going down that low are probably unlikely, but just the velocity of a crash. You say we wake up and the stock market's down 5%. These contracts are going to go up a lot in value, even though they are nowhere near close to in the money still. So I do like to go pretty far down just when you're getting time, because I like to flip out a lot of these contracts. So to break even on these at $95, if you bought the 245 put $95, you would need the S&P to fall 41.26% to be in the money by September, by your expiration date. But even, like I said, if the velocity of the stock market just starts to go down really fast, these will go up in value. So you don't necessarily need the stock market to close under 245 to make money. You do and you don't, because you could sell out of these when they go up in value a couple 100% or even a couple 1,000%, depending how fast a crash or correction happened. But you definitely wouldn't want to hold something like this all the way to expiration, because I don't think the SPY is going to close at 245 by September. If it does, we're probably all in a lot of trouble anyways. But that's another way you can hedge your position. Another way to hedge your position is with the UVXY, and this is ProShares Ultra VIX short-term futures ETF. And essentially what this is doing, it's tracking the volatility. So it's tracking the call to put ratio. And you see, I even have a trade on this. I put this on May 18th. So it has been a couple days, and the stock market is actually rebounded a little bit from when it was down, and the VIX has went down a little bit since I put this trade on around here, right before it was at 450. It goes up. This contract actually shot up a lot in value, but I just wanted to hold it because this is my insurance. So this was actually up about 130%. It reached $136 at the high. What was this, May 12th? Yeah, something like that. It went up a lot in value, but I decided to hold it. And like I said, essentially this is just measuring the volatility, how fast the market goes up and down, and the call to put ratio. So if there's a lot of people putting puts on stocks, then these contracts will hold value much better than if they weren't. Like right now, this UVXY $6 call would have been down more, but there's more people that are buying puts right now to stabilize the VIX, or the UVXY, whatever you want to call it. That's the ticker symbol UVXY. So essentially during a market crash like we've seen, you know, during March, just go back all the way to March. Actually, I got to pull out the 5-year, and it's going to look really small here, but we went from about, you know, $10-11, and this is designed to go down over time, but we were at about $10-11, and then once we shot up March 20th to $91. So you can make a ton of money if you hit this correctly. This is why this is one of my favorite ways to hedge my long-term positions, because of how much money you can make. So if you had this $6 call and the UVXY went to $91 and you sold out at the high, you would make about $8,500 in profit off of this $50 contract you bought. Now, that's the thing. If the stock market doesn't start to go down, or, you know, not a lot of people are buying puts, then odds are most of these contracts will expire worthless. But when you do hit it, you can hit it really, really big. So those are my favorite ways to hedge your position. You can also do SPXS, and this is a 3 times leverage S&P 500 fund. Basically the same thing as the UVXY. It's just a little bit different. It's designed to go down over time, like you can see, pretty much the same thing. And if we do look back to February 20, or about February, March 2020, we were at about $120 on this, and then it shot up to $253. So essentially the same thing. You can make a lot of money if you hit these corrections at the right timing. So it's always good, you know, to play it small and have some exposure. And for the most part, they're you know, not too expensive considering how much they can move. I was actually on the puts, but you go to the calls, you know, the $55, and we went to about $250. So that would be a ton of profit if you did buy these and the stock market actually did crash. So I am looking to hedge my positions, probably with a mix of all 3 of these. I do have quite a bit of hedges already. The UVXY, I have the SPY, I also have the IWM, which is another way, but it's not, you know, one of my favorites. And this is just the Russell 2000, and you just buy puts on this. Same exact logic. If the stock market does go down, like what happened in March, this would go down in value, and then hopefully you're somewhere near the money. And I do have these August 20th 110 puts for 2 of them, and I spent $20. I'm down $6 a piece, and this is one of those that you're not going to get in the money on this. Even if the stock market does crash a lot, you're not going to get in the money, but it's a cheap way to protect yourself and make a lot of money, because even if you do come down to, you know, the October 2020 level, you would make a lot on this contract. Just people implying the stock market would fall more. So that's 4 ways you guys can hedge your long-term positions, as well as, you know, the indicators I am looking at that are 100% saying that we are going to crash in the stock market sometime in the near term future. I don't know when this will happen, if it'll be next week or a month or 2 or 3 from now, but sometime in that time frame, we're definitely going to see a downtrend and correction. That is just my opinions. Do your own research. If you agree with me, that's great. If you don't, that's great too. I don't really care. I'm just letting you guys know what I'm doing and how you can protect yourself and essentially monitor the same aspects that I am looking at. So with that being said, make sure to stay protected and prepared, not scared, like I always say. Until next time, guys, I will see you later. Take care.